China is on the verge of an economic, political, and social system collapse that could plunge the country into a civil war and end China's aim of capturing Taiwan forever. The financial system has already failed, and Chinese citizens are unable to withdraw funds from banks. People are being told that they must wait for government cash. This is a common method used by communist governments to maintain control over their populations. But this time is different, as people are revolting in every other city. Hey, welcome to Stock Market Mate. Today we'll talk about China's current economic status. Is it really collapsing? That's what we'll find out in today's video. Before we get into it, subscribe to the channel and hit that notification bell to help us beat the YouTube algorithm. If you're done with that, then let's get right into it. China's current economic and social data. The real estate and construction industries have also reached rock bottom, with builders unable to complete their projects and a substantial number of enterprises defaulting on their loans and project commitments. China's real estate market is valued at $50 trillion and accounts for 25% to 30% of the country's GDP. Massive protests are taking place now that 30% of the GDP is in limbo and people are not being paid their fair pay, and the government is using extreme force to conceal these difficulties. While everyone in America is talking about the recession and the Russia-Ukraine invasion, most of us have chosen to disregard the truth about what is going on in China. China's current economic and social data pose some severe dangers to its economy. The consensus is that the Chinese economy will implode. The Communist Party of China has already recognized the impending tragedy and has been doing all in its power to prevent further collapse. Of course, this will eventually act as the final nail in the coffin of the entire world, which is already seeing signs of recession and depression. Cathie Wood, the chief analyst at Ark Invest who presently manages $20 billion in funds, has already recognized the suffering that the globe would face because of China's crisis. According to Cathie Wood, the United States GDP growth has already eclipsed China's for the first time in the last 5 decades. So, we'll unpack China's current condition and some stunning statistics that indicate the country is on the verge of a major collapse. But first, we want to draw your attention to China's historical perspective. China's historical perspective. Prior to 1978, the country operated under a centrally planned or command economy. However, the country has experienced exceptional growth since it opened the economy. According to the World Bank, China's average GDP growth rate from 1978 to the present is roughly 9.24%. Since they opened their doors to the rest of the world, their population has seen significant prosperity, and around 800 million people have been able to flee poverty. Education, health, and technical growth in China have advanced dramatically over the last 40 years. However, this exceptional expansion is centered on China's expanding liabilities. As a result of the economic boom, the net worth of those Chinese who took out loans increased dramatically. As a result, more and more citizens followed suit, and the economy began to expand at an exponential rate. The cycle represented a positive feedback loop, and the paradigm served China well for many years. China accounted for 18% of the global GDP in 2021. Although China is recognized as a manufacturing superpower, according to Loomis Sales, 70% of China's total wealth is in the rear sector. And after 20 years of appreciation, China's real estate is now worth $50 trillion. China's property and related industries account for approximately 25% to 30% of its GDP. Property developers have borrowed billions of dollars and grown their real estate portfolio to hundreds of locations over the years. However, citizens can no longer afford a normal city house or apartment. There are numerous beach cities surrounding Beijing and Shanghai, but no one lives there due to the high costs. But as the saying goes, every life has a death. The country's current debt situation is unsustainable. China's general government debt to GDP ratio is at 77.8%, while the bank assets to GDP ratio is over 300% compared to 75% in the US. As a result, the numbers speak for themselves, indicating that the country's liabilities are unsustainable. The 3 red lines policy. According to some, China is currently undergoing the world's greatest real estate bubble. President Xi is aware of the looming calamity and is putting in place numerous rules to keep the situation under control and prevent further collapse. He adopted new property taxes, as well as the 3 red lines policy to regulate the capital appreciation of real estate. The amount of debt that property developers can incur is limited by this policy. As a result, housing prices are falling in tandem with a reduction in new home sales. In July, home sales decreased by 39.7%, Property and allied businesses contribute for around 25% to 30% of China's GDP, so a 39% loss in this sector will result in a large drop in the GDP. Furthermore, the Chinese government has been pushing a zero-COVID policy, which necessitates stringent controls and has serious economic consequences. That is why banks and economies have consistently reduced their GDP predictions for China. China's crackdown on over-leveraged enterprises could set off a negative feedback cycle, in which people default primarily on loans, resulting in an economic slowdown that will eventually lead to subsequent slowdowns. While the Federal Reserve in the United States has been raising interest rates to combat rising inflation, China's government has been cutting interest rates to save its economy. The prime lending rate in China, which applies to both residential and commercial loans, is now set at 3.7%. It is expected that as time goes on, this figure will continue to fall. Most investors feel that China's real estate crisis is a one-off occurrence that will have little impact in other countries. Cathie, on the other hand, feels that if China's economy collapses, it will bring the rest of the globe down with it, potentially resulting in a global slump. According to the existing equation, a rise in the US Fed rate increases the value of the dollar while having an immediate negative effect on the value of the yuan. As a result, a weakening currency reduces the purchasing power of an already collapsing economy. So if the Chinese economy fails, it will be a worldwide disaster, given that the US and Europe are already in perilous conditions. Furthermore, the bond curve has lately reversed, indicating a possible recession. When the 10-year Treasury bond yield is less than the 2-year Treasury bond yield, the real curve is inverted. When the interest rate for a shorter period is higher than the interest rate for a longer period, it indicates that the near-term risk is greater than the long-term risk. As a result, Cathie linked Fed rate hikes to international issues, arguing that raising interest rates strengthens the currency, and other countries, such as China, must deal with the economic ramifications. As a result, the Fed appears to be playing with fire at a time when global economies are particularly vulnerable. As a result, a crash in the United States will send every other economy into uncontrollable instability. China, fabricating economic data. The world's most recent global recession occurred in 2008, when many countries experienced an economic downturn. However, during 2008, China's GDP grew by double digits, while Asia, Australia, and Africa had no significant fall in GDP. The current scenario, however, is more futile because Asia, Europe, South Africa, Australia, and America are all experiencing economic weakness. We have witnessed Sri Lanka's defaults, and while China's current numbers, which account for 18% of global GDP, appear bad, there is a good likelihood that these figures are fabricated. Where to put your money for investments? So, as an investor, how to plan one's portfolio is a million-dollar question. If you keep cash on hand to prevent inventing risk, inflation will chip away at your savings. Diversifying internationally is pointless because both Europe and Asia are struggling. So, investing in the US market is the best alternative because it is still in a better position than other worldwide markets. You may think that there is significant inflation, but trust me when we say that the dollar index remains strong in comparison to other currencies. Despite massive inflation, the index is rising. Gold is another wonderful investment opportunity, even though there is little possibility of a price decline due to the slowing of inflation. Of course, every asset has a disadvantage. As a result, in the current situation, the best option for investing in assets that can reduce volatility and provide crucial positive returns. So our advice is to retain 25% in cash, 5% in gold, 5% in Bitcoin, 40% in ETFs, and 25% in individual equities. Such a portfolio will not provide high returns, but it will mitigate negative risk. However, you can still purchase the drop for long-term returns. Well, that's about it for today. If you found this video helpful, kindly click the like and subscribe button. Also, you might want to leave a comment below. We love hearing from you. Thank you for watching, and we'll see you in the next video. If you enjoyed this video, you're going to want to watch one of these two videos right here. Enjoy!